Good morning. I'm Stephen Gibson, Chairman of the Investment Committee at Affinity Wealth Management. I'd like to discuss this volatility we're seeing at the beginning of 2016 in the U.S. stock market. You know, we just got through with the 10% correction in August, which we recovered from, and here we go again in 2016 with the market down about 10% off its highs again. That's only happened twice in history, so investors have a right to be concerned. But I think it's a good time for clear-eyed perspective about what we can expect from the U.S. stock market in 2016. I want to discuss some of the questions you may have about your portfolio in this stock market correction. First of all, why are markets going down right now? I want to talk about China. It's getting a lot of attention with this early volatility. What impact does that have on the U.S. economy and our markets? I also want to talk about oil. What is this sharp decline in oil telling us about the end of the U.S. recovery? An important question is, of course, what is the impact on your portfolio if you're a retirement investor? And finally, is there any good news in this, or is the U.S. going into recession and a severe down market? There is some good news I want to talk about. So there are about four main drivers of the decline so far this year. And the first, of course, is China that's gotten a lot of the headlines. The IMF and World Bank thought that China would grow 6.8 to 7%. The early numbers are coming in just a little lower than that. It's always hard to tell precisely how fast China's growing exactly, but there's a fear that maybe they're not going to continue to grow and that that'll have an effect on world economic conditions. So that's one driver. Second driver is really oil. We've seen a 70% correction in the price of oil. Feels nice when we fill up our tanks, but about 10% of the companies in the S&P are related directly to energy. And when it comes to heavy equipment and manufacturing and materials, those are also impacted by lower oil. The third thing is that we're seeing the beginnings of a recession in manufacturing. Now, that's not so bad for the U.S. because we're not a manufacturing-led economy. But it's not good news, and that also is creating some negativity. And then finally, in the midst of all this, even with all that going on, the Federal Reserve has decided that they'll go ahead and start raising interest rates to prevent inflation. And there isn't really a lot of inflation. And whenever the Fed has tried to engineer precisely by raising rates with little growth, it generally sets the stock market back. Let's talk about China. It's getting a lot of attention in U.S. stock markets. Even though China is only 7% of our exports, it's less than 1% of our GDP. And if China had a tremendous problem, it's actually unlikely that it will directly affect the economics of the United States. However, let's look at China. China is growing. There's a lot of debate on whether it's growing 5% or 6%, or the economists at the World Bank and IMF thought, that it would probably be 7%. But it is a growing economy, and they're changing from a manufacturing economy, which of course is going through tough times, to a service economy, and they're making remarkable progress in that regard. But the most important thing is that market's been correcting now for almost 6 months, and it's now about 15 times earnings. That means it's less valued than the U.S. stock market is. So for that reason particularly, we think the worst may be just about over in China, and it's probably been overblown to begin with. Finally, one other thought about China. Let's remember that this is a communist dictatorship trying to have a bit of an entrepreneurial economy. But there's a deal in China. The government makes sure that things go well, and the citizens give up a lot of freedom. Believe me that the leaders in China are going to do everything they can to make sure that there's continuing stability in the Chinese economy, and they actually have a lot of tools to do that with. Let's turn to oil for a moment, and this oil glut has certainly confounded the experts. The oil price is down 16% just this year per barrel. It's down 70% from the high. And because not only oil companies directly, but also those that support and sell equipment to the oil industry are down, you're not going to have the stock market get good momentum until oil finds a level bottom price. And the benefits of low gas are quite considerable, but so far the consumer's been cautious and hasn't been spending all those savings at the pump. Overall, what this is a supply problem. We are seeing demand slowly growing, and slowly but surely in the US we're taking our rig count down. So we are going to see oil supply slow down later this year. But first we have to get Iran to bring its oil onto the market. And then later this year, with the US lowering its production, we should see oil find a bottom because the market will anticipate that early. The important thing to remember about oil is that at Affinity, we have avoided that sector, oil and industrials, by using other sectors to get exposure to the stock market. So we're actually fairly well insulated from the effect of oil. So let's ask the important question. Is the US economy going into recession? Unless it does, we're not going to have a bear market. We're just about at the end of a correction. So this is a consumer-led, retail-led economy in the United States. 2/3 of everything is pretty much driven by the consumer and spending. So we see very solid retail sales. We see very strong employment numbers, even recently, and even wages are inching up. So of the 4 charts we always look at, only one, that's industrial production, is showing any decline at all. And so far that's not severe. And as the inventories get worked off, that actually could even recover later this year. So we see no signs of recession. And to us, that spells just a correction in the stock market that should be over soon. So what if we're wrong? What if, in fact, this recession is just starting and just not showing itself yet? How do we protect our retirement portfolios? We always ask that question at Affinity. What if we're wrong? And so there's several things about your portfolios to keep in mind. One is that almost all of you have bonds in your portfolio. And we have made those safer by eliminating a lot of high yield and interest rate risk in the portfolio. As a result, those portfolios are actually up, though the stock market is down. So bonds can help a portfolio. That's one reason we own them, even though returns are low, in a down stock market. Secondly, remember we do have the bull and bear, and if we see a solid sign that we're getting a bear market, we will move assets to the sidelines or into safer assets. And finally, many of you have been placed in private investments. And we told you then, all through last year, that we saw this coming. We were worried about the volatility in the stock markets. The good news I can report is of the 4 major private investments we put people in, all 4 are doing quite well so far. So they're on target to get their 6.5% to 8% so far. That looks very attractive. And if you'd like to talk to us more, there are some other alternatives like that that may do well by providing income when the stock market may actually be declining. So there's several steps we're taking to be very vigilant to protect your capital in your retirement accounts. Finally, we've talked about the negatives and the concerns, but we're becoming very positive on the US stock market. We've returned to fair values with this correction, and the consumer is in very good financial shape, and so are American corporations. So we see real opportunities in technology, healthcare, retail stocks with the consumer spending more, autos, home building, all should be pluses. So we have a very good chance to recover from this correction and move on to the potential to build some wealth this year. So I want to thank you and end on those positives. I also want to invite you in March to our Blue Ball Barn market update and invite you to bring a friend to that as well. And most of all, I want to thank you for your loyalty to Affinity Wealth Management. Thanks for listening.